Welcome everyone to the Kendall Report. I'm Bob Kendall. I share my 40 years of experience to help you manage your portfolios and protect your wealth. Don't forget to subscribe, like, and share these videos. Well, yesterday we saw a fair amount of downward pressure in the market. While that was evident throughout most of the session, in the final half hour of trading, we saw short covering pushing the markets only slightly lower in the day, and the NASDAQ was actually able to close higher. The tech sector continues to show some interesting strength, which suggests the underlying pattern that I've been talking about over the past several weeks remains intact. While my expectations are for a short-term retracement, it doesn't appear that there's much to drive it extremely lower. As I mentioned, only a moderate decline is expected. We still have some upward pressure, and the trends are still suggesting that there's a positive tone underlying in this market. As we start to step through this week, there's not a lot of material economic news to come out. Starting to see stability in the markets. We have one of the narrowest ranges in the S&P that I've seen for some time. Also, volume was down just above 5.4 billion shares. This is important. I've been talking about this over the past several weeks. As to see some stability, the ranges contract, all of those things happen. I'll unpack this in the technical section when I go through that here shortly. But from a fundamental standpoint, overnight, there was some news out of China that was perceived to be bullish, and the markets all shot up. The futures are up between 1 and 1.3% overnight, and this is likely to remain intact as we come into Tuesday's opening. It's interesting to watch the psychology that's going on behind the markets, because as we know, the U.S. economy is still shut down. Things aren't getting any better, and there's still a lot of rhetoric going around about being shut down for months. I've talked to some folks in California that the governor is saying that they're looking at the 1st of July. This is an impossibility to keep the economy shut down at that level for that long. We have to get back on track. We have to start to get back to work and start opening segments of the economy. We're already starting to see a lot of things breaking in the background. That's not going to change. The market activity is being driven by the Fed's stimulus and the underlying tone from the government through the fiscal and the stimulus. This is not likely to change anytime soon. They're going to keep their foot on the pedal for sure. I'm all for this thing working and the country not sliding into a depression. But the longer they keep this thing shut down, the more the risk builds of a catastrophic situation. But for now, market flow continues to stabilize, as I mentioned earlier. We're starting to see spreads starting to contract, which is another positive sign. Liquidity is coming back. Even though we've had a lot of volume over the past several weeks, it doesn't mean that the markets are liquid. The spreads tell us a lot more about the illiquidity than the actual volume in the market. So going forward over the next couple of days, it's going to become very tenuous. Tuesday's activity will be extremely important for the balance of the week. Depending on how we trade tomorrow, if we can close up over some key areas that I'll cover in the technical section, then there's some possibilities of continuing to move to some of the areas that I talked about last week. The correction may be on hold, but ultimately there will be a correction, whether it comes in the next couple days or whether it's postponed for 3 days and then we see a correction. But there's no way that we're not going to get some sort of correction in this pattern. Now, the one thing that could trigger a further rally would be if the economy was announced that it's going to be open, let's say in a week or 10 days. That would be very positive. That would be before the end of the month, which would suggest a much more bullish situation. Once again, I'm all for it. Our short-term models are long, but the intermediate models still have a lot of work to do. And the probabilities of a V-bottom is still, in my opinion, very low, but we could see some further rise, and we will see some backfilling. This is not going to be a straight line up, especially since the backdrop in this economy is that it's closed. There's no income being produced. There's lots of money being doled out everywhere you look. There are billions and billions of dollars in loans being made to businesses that they're telling they're just going to be forgiven. So it's just a freebie handout, and a lot of people are taking advantage of it, and why not? But in the end, that doesn't make a good economy. After the big rally that we saw 08 and early 09, we saw the rally into 10 and 11. We did go into a stagnant period. This is much different. The economy wasn't shut down by a social event. It was slowed down by a financial event. This is going to be much different. No one knows how this will play out, but for sure there's going to be lots of dynamics and much more volatility. Still watching the bond markets. They're stabilizing, but there's still plenty of risk to deal with as we go forward, because many entities are not going to have the cash flow to be able to pay their bonds, especially the municipalities, and some corporations are going to really struggle to be able to support their debt going forward. There's a situation that could trigger at any moment that would send these markets back in to correct. So continue to be cautious. Our short-term models are still long. I will go through this in the technical section. Let's go take a look at the charts and see what we can see there. Looking at the S&P 500 E-mini futures, we're seeing quite a bit of strength overnight, up 1.65% right now, breaking above the 40-period moving average. One of the things I want you to notice is that the PPMs 1 and 2 have turned down in spite of this strength. This is very typical of what happens when we're reaching the top of this zone. This is the 8th day of the pattern. I discussed last week about a pattern that was going to be a 5-3-5. It looks like it's extending into a 5-3-8. There's still a high probability of the markets topping here, and with the overnight activity, a lot of times we've seen this fade by the time that the open comes on the next session. So this activity is very positive right now, but it may not play out into early morning. As I mentioned in my opening comments, this had a lot to do with some of the numbers, economic numbers that came out of China. Somehow China doing better than we expected is good, maybe because they're expecting that the U.S. will do better than expected as well. The U.S. won't do better than expected if they keep the economy shut. And I think it's pretty obvious when you look at this pattern that this is a clear ABC. It's extending. I talked about last week of a target range of 2850 to 2920. That's still a possibility. We could see it surge up. That's going to put us close to the backside of the 200-day moving average. So this pattern continues to extend. We look at the weekly graph on the S&P futures. You're going to see we're right up against that 10-week moving average. This is important to note. The PPM1 is a negative 1.78. This suggests that there's only a 20% probability for the S&P to close above this level on Friday. Let's switch over to the cash so you can see what that number is. The 10-week moving average on the S&P cash is at 28.24. This also coincides with a probable top here. I'm still expecting to see this pattern of a zigzag unfold, and with this downward pressure and the PPMs actually turning lower, this lends a high probability for the pattern I'm about to draw in to unfold. This is the top of this pattern. We should come down 2660 I discussed last night, and a possibility of going down to this 24 level. But these moving averages are going to continue to roll in here and set the top of this pattern. So we're likely to see this move into these patterns. That would be the 2920 level. But this is a weekly graph. This would be several weeks from now. So the expected pattern to unfold would be as follows. 3 weeks up, then this next rally would move us back towards this 2850, 2900 level, and then these moving averages will be in play when that happens. We had 3 up, we should have 3 down, and there's possibility of a 3-3-5, which means there would be 5 weeks up. It's very seldom do we see a 3-5-3. Those are very odd. The typical pattern would be 3 up, 3 down. The minimum will be 3 weeks up. Most likely we'll get 5 weeks in the next pattern. This literally puts us out into mid-June when this pattern is going to be complete. At that point, be able to determine what is next. I've actually discussed a double zigzag type pattern where we get a consolidation and we stay in this range. Thanks for watching this video. Don't forget to subscribe, like, and share. I will be updating any of these patterns that I see intraday on my Twitter account. Thanks again for watching.